Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups. Brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Well, so I'll just let you have a quick look at the disclaimer. I'll just run through what we hope to get through in the next 30 to 40 minutes or so. Might be a bit on the longer side as there's so much happening in markets coming up this week. Yes, so firstly, we'll just check out how markets are trading currently. We'll look at some brief thoughts on that US-EU trade deal before then getting into earnings, some figures on the earnings that we've seen. We'll briefly check out Tesla and Google from last week before then previewing quickly the Mag 7 results for this week. So Meta, Microsoft, Alphabet, not Alphabet, sorry, Amazon and Apple. They're coming up this week. So really packed week for equity markets. So we'll look at those charts as well. Then we'll just briefly touch upon that you can see here. We'll briefly touch upon the ECB meeting from last week and some thoughts around that before then getting into, obviously, as I said, an absolutely jam-packed week of risk events. We have central bank meetings, so the Fed meeting, the Bank of Japan meeting, the BOC, the Bank of Canada meeting as well. So we'll look at those and all the currency pairs associated with those meetings. There is obviously as well a bunch of economic data, top tier economic data. So non-farm payroll could be actually the biggest event of the week ultimately. That's on Friday, of course, the first Friday of every month, pretty much. So we'll look at that and some other US data. Of course, there is PCE deflator data. That is the Fed's favored inflation gauge. So briefly look at that and also Q2 GDP of interest. And in amongst everything else, there is some Eurozone data as well, CPI data and GDP data as well. And hopefully we have time for some Aussie data actually as well, important Q2 inflation data ahead of the RBA meeting. Yeah, hopefully we'll have time to touch upon that. And of course, the tariff deadline on August the 1st, Friday, which kind of is still there. We know it will probably be pushed back. But of course, still a deadline on the calendar. So much to get through. And I should say, if you do have any questions, please do ask them along the way in the chat box, and we'll hopefully answer those for you as we go or at the end of the webinar. I should also say briefly as well, we do have a big webinar tomorrow as well. That is at 11 a.m. UK time, so an hour earlier than this one. That is tomorrow, so that's 8 p.m. Australian time. I think it's 6 p.m. Malaysian time, where myself and Hebe Chen, who's the wonderful analyst in Australia, based in Australia, we'll go through the earnings results, actually previewing and reviewing all those results in more detail, actually. That is tomorrow, and we'll then look at the general market outlook as well. Okay, first up, how markets are trading currently. Just a few charts really to get, just to look at earnings. Before we do, obviously we've had that trade deal announced, 15% tariffs for the EU with US goods, and the EU is set to buy or plans to buy, is being told to buy $750 billion worth in US energy and $600 billion worth in investments, mainly military equipment, I think. US and China, they're expected to extend their trade truce by 90 days, according to Chinese reports. Their deadline actually was August 12th, and Treasury Secretary Bezin had already lined up the fact that there could be a sort of 90-day rolling deadline in any event. Asian stocks, they are, well, pretty mixed actually. Japan lagged due to political uncertainty, still evident there. US futures are up around 0.25%. Europe is firmer with Euro stocks up around 0.9%, I believe, last time I looked. The dollar, interestingly, sort of was fairly quiet, but it has picked up some buyers now. Obviously, there's data risk heavy week. We're likely to get a GDP bounce. and then also sticky inflation in that PCE data. So possibly markets looking ahead to that already. But of course, euro as well is taking the brunt of the selling this morning. It's below the 117 handle, with the dollar yen now above the 148 mark. Interesting, really, whether there's a bit of profit taking there, sort of buy the rumor, sell the fact type event, and whether we get that on the China data as well. Not seeing that in stocks, but more so in currencies, with that euro selling, and there's reasonable sort of long positioning in the euro. So yes, whether we're getting some of that euro positioning taken off slightly on that EU US trade deal. Regarding that, then, President von der Leyen, she has confirmed a 15% rate is for a vast majority of EU exports, including cars, semiconductors, and pharma. So that's really important. But there's still 50% tariffs on steel and aluminium. European politicians, they're essentially hoping this deal will bring some certainty really to businesses, and then unlock much needed investment. Investment intentions in PMI surveys, they will be heavily scrutinized over the coming months. So just watch out for those, of course. We'll be previewing those when they come up next. Whether, of course, this deal is the final deal remains to be seen. That's probably to be said for all these deals that are being sort of announced, but the detail is slightly thin. But ultimately, you have to say in the eurozone, essentially fundamentals are not too bad, really. There's a high savings rate, lower inventories, and certainly this big fiscal expansion is coming. So, yeah, interesting times for the eurozone. As I said, the speculative market, reasonably long euros. And there's also this sort of 2% per annum cost of carry versus the dollar to deal with. That doesn't really seem or doesn't help those long heavily positioned in the euro, and that, as I said, sort of profit taking by the rumor sell the fact type event is being seen, I think, this morning. So that's a trade deal. If we now move on to stocks, just show you a couple of charts. Firstly, this one, which is sort of the most up to date from FactSet, actually, which are the sort of gurus in following earnings. You can see the S&P 500 still expectations for around 6.4% earnings, with then tech and communication services leading the way, double-digit gains there on earnings growth, whereas energy still seen as fairly well, the laggard by some distance, down 24% their earnings growth. Yeah, that's the current state of play. It hasn't really moved really from the end of June. You can see there the S&P slightly higher expected earnings growth now, and as I'll get to, actually, this is essentially due to Wall Street analysts cutting sharply their estimates after the sort of April Trump Rose Garden event, should we say. But then that bar being raised slightly, but not that much, and therefore companies beating estimates. Just some facts and figures on that then. So far, we have seen 168 S&P 500 companies. That's around a third of its total membership, around 38% of the market cap of the S&P. That's so far what we've seen. Total earnings for those companies up over 8% from the same period last year, and that's on 4.9% higher revenues. And then 83% are beating EPS estimates, and 80% are beating revenue estimates. Those EPS and revenue beats actually are tracking notably above the historical averages for that group of the 168 companies already reported. So that's what we have seen. Going forward, then this week we get another sort of around a third of S&P companies reporting in this single week. I think there's 164 S&P members reporting. And we've seen, or we will have seen, Q2 results then by the end of this week. Obviously, around 2/3 of the index's total membership will have reported. I think the overall picture is interesting, of course. And really, Q2 earnings season remains positive. That's what we're seeing in the broader indices, of course. But it isn't simply, as I've sort of mentioned, touched upon, simply companies beating estimates that were too low to begin with, and that being a reflection of analysts really sharply cutting those estimates, as I said, in wake of the Liberation Day tariff announcements. But more really, it's been driven certainly by AI being a key theme. Sounds obvious, but yes, that's the key theme, still in full flow, really, and the market is dancing to that tune, if you like. Um, and that is still very heavily influencing companies' results and also how markets look at companies. So those businesses focused on AI have been doing really well, whereas those sort of businesses focusing on probably other or probably actual people, should we say, they are struggling, and that comes in the face of uncertainty over US policy, over trade policy, and that's then affecting or boosting costs, is upending supply chains, and then has hurt consumer confidence. So, for example, Coca-Cola, Nestle, those big food manufacturers, airlines like American Airlines, Southwest Airlines, and then even sort of luxury bellwethers like LVMH. They've all struggled really on their results, whereas um, yes, as I say, businesses focused on AI evidently are doing very well. Mag 7, of course, is in amongst this. They account for now over 30% of the value of the S&P 500. So essentially, the market is mirroring the economy, but also then where the Mag 7 go is where the wider indices will go ultimately. Um, We have seen resilience, I should say, though, also in major banks. We had that a few weeks ago, actually, with those banks exceeding expectations due to pretty robust trading profits, and of course, as well, investment banking revenues doing well. Also, looking ahead, markets are probably caught between kind of solid earnings momentum for sure, but then also some lingering policy risks. Um, and that is, yeah, generally kind of what we're seeing of sorts, although obviously the market indices are going higher really on the back of those mega cap tech earnings that we have seen, and ultimately expectations that they will do well this week. If we just move on, we've just got another couple of charts. Here's the Mag 7, or some of the Mag 7 actually from that low in April. And you can just see Microsoft Meta doing really well, outperforming then the broader Mag 7, which is up over 39%. Since that low on April 8th, I think it was, yeah, that I got here. And then those laggards really, so underperforming the Mag 7, underperforming the S&P really, is Apple up only, as I say, only 24%, S&P around 28%. Google, Amazon up 33 and 35%, but the Mag 7 as a whole up 39%. But of course, that includes Nvidia, which isn't on this chart. So just for your guide, where we are currently coming into, of course, this week, and those results, which will be, of course, after the US close, Microsoft and Meta after the US close on Wednesday, and then Apple and Amazon after the US close on Thursday. Just briefly then, just on sort of Tesla and Google results from last week, I'll just pull up a chart actually, first of all, of Tesla's results. Or not a chart of Tesla's results, sorry, a chart of Tesla price action, which saw a big sell-off after those results. Ultimately, they disappointed the EV manufacturer by foreshadowing really tough upcoming quarters to come, if you like, because well, certain things, but certainly a decline in EV subsidies will affect the car company. Elon Musk, of course, he said there will be a quote. I think it was a rough few quarters going forward. And really quite interesting, just this sort of pivotal phase now that Tesla is in, actually, in its evolution, a sort of transitory period, if you like, where it's got these sort of key growth areas of energy storage, robotics, AI powered transportation. But then, of course, it is this choice between where the business stands at the moment, with the sort of it having been an EV leader, if you like, but now increasing competition from China, the brand sort of tarnished slightly, and then competition elsewhere. That then battling, if you like, with how probably Elon Musk sees Tesla going forward, which is this sort of future tech leader, if you like, and that is one where robotics, as I say, energy systems are really more important than the EV side, if you like. Of course, there are tech synergies between EVs, robotaxis, robotics, and energy systems, but ultimately, I think the vision is that well, there will be execution on this sort of integrated vision, of course, in this fast-moving market or marketplace places that Tesla operates. So, sort of interesting balance that is being played out, and as I say, evolution of Tesla as it goes forward and what the market is trying to price. I think from memory, one of the big sort of big supporters of Tesla in previous years, he has estimated that the robotic side, if you like, the future tech side, is worth about $1 trillion, which is where sort of Tesla is at the moment, give or take. So then, how much is the EV business worth going forward? And then, obviously, then a future tech business going forward as well. That's the thoughts on Tesla, I guess, or our thoughts here, I guess, from the technical point of view, charting point of view. You can just see that dip down below the black line, the 200-day moving average, and the blue line. That's the 50-day moving average there at 319 and 325 respectively. We obviously got to that low on Thursday after the results at 300, but then fans are buying. Also on Friday, I think there was some news out about robotaxis being broadened out in the States. Some of the estimates, again, just to touch upon those, was slightly interesting, should we say. If you remember, of course, in 2019, I think Elon Musk said robotaxis will be across the states within the year by 2020. Of course, that hasn't happened. And also then some of the estimates now for robotaxis being across the states again by end of next year, I think was the forecast. Again, looks interesting, with that being fairly minimal at the moment. And if you remember the Austin event in June with the rollout of the robotaxi, or the demonstration, really, there was still safety issues potentially. Tesla employees sat in the passenger seat, and it was a fairly controlled event. So, just a couple of things to watch out for there. But of course, a lot going on with that stock in general anyway, with the EV competition, as I said, but also then this evolution phase. Technically then, 300 possible initial support. You've got a barrier of resistance at the 200-day and 50-day, around 319, 325. And then you can see some fib levels as well. We're at the sort of 38.2 of this decline. That's at 319 as well, reinforcing that sort of zone. We move on to Google briefly. That's Alphabet's obviously parent. Just bring up the chart here. That responded well, of course, to results. Ultimately, markets liked the surprise capital expenditure hike, which really revised optimism in AI investments and returns. Again, sort of two businesses with Google, the cloud division, of course, going fantastically well. That sells computing power in data centers, and of course there's around, I think, 32% year-on-year growth, so increasing profitability, and even bigger increases in those big sort of enterprise deals that have been going on and will continue. But then obviously you have the search business as well. There were concerns possibly about threats from users migrating to, of course, ChatGPT and other LLMs, large language models, but still Google search has 90% of global share and around 5 billion, I think it is 5 billion users per month. So a huge advantage Google still has, and it's maintaining those. I think revenues were up 12% versus 9% expectations. And along with that big increase in CapEx, I think it was to 85 billion from 75 billion. And it also sees more in 2026, then certainly that was liked by the markets. You can see here we've got this sort of bull channel, this ascending channel, higher highs, higher lows, and then we popped up to the top of that channel, if you like, just below $200. You've got a sort of 78.6 fib retracement level of this sell-off this year. That's at 194, which we broke above. So you've got 200 there, and then obviously the all-time highs at 208.70. We are overbought, you can see on the daily RSI. And yeah, just touching that upper channel. So interesting, as then you can see the blue line is crossing above the black line. So crossing 50-day moving average, crossing above the 200-day moving average, which is a golden cross. But kind of sometimes that is not the best indicator, and really better to use it with other indicators as well. So yeah, interesting chart in Alphabet. Otherwise, just quickly, we're going on here. We do have obviously those other earnings this week as well. Just a few thoughts on those. Firstly, Meta, then Microsoft, Apple, then Amazon. Meta, interesting, really. If I just pull up this chart, first of all, which is here, doing really well year to date. Ads, of course, doing really well. Revenues, 14.5% growth, I think, is expected. That would actually be the slowest expansion rate in 2 years. Eyes probably again on CapEx numbers after Google's numbers, of course. And in the last quarter, Meta have raised those from around 60 to 65 billion to 64 to 72 billion. So wondering whether that will be increased again. That's all around data center investments, of course. And Mark Zuckerberg has, I think, recently said he expects to plow hundreds of billions of dollars into AI corporate infrastructure. As I say, Google markets responded to Google's announcements very positively. So yeah, that'll be the interest for Meta, really. Chart wise, you can just see sort of bullish consolidation, really, just below those recent highs. The all-time high at 747.90 there, and then you've got support around the 50-day moving average just below 700, and then you've got a swing low from mid-July at 704 as well. That's Meta. Microsoft, just briefly, Azure, it's all about Azure, of course. That's at the heart of Microsoft's AI ambitions. Quarterly revenues, I think, are around 35% expected. Prior was 35, so a touch below that. So yeah, those would be Microsoft's probably key. That'll be Microsoft, sorry, key number. Just on expectations, just for your guide quickly, sales are and earnings growth are expected around 14%. I think revenues 73.8 billion, and then an EPS of $3.38 expected for Microsoft. Moving on to Apple, let me just pull up the chart again. Bear with me 1 second. Yep, here's the Apple chart. Different picture, of course, with Apple, and I showed you that really on that chart previously, with it comparing against all the other Mag 7 stocks as well as the S&P 500, underperforming that, down around, I think, 12-13% year to date. Really different picture with Apple, of course, not really AI related as such, just the mega cap tech stock, of course, much more worries then about tariffs, of course, supply chains, and then China as well. Tariffs, there was meant to be a $900 million hit, so whether that's still valid will be interesting. And then as well, any guidance from the company will be important. They didn't give any, I don't think, last time around. So again, this time, as there is possibly a little bit more certainty, although tariffs again an issue, and especially with China, no deal done yet, and that deadline put off. So whether the Apple will even give guidance, it remains to be seen. Yes, different picture then for the iPhone maker. Just on their numbers, I believe, yeah, they're expected to report EPS of around $1.42. That's on revenues of around 89.1 billion. That would mean pretty modest growth then of 1.4% on revenues, 3.9% on, sorry, 1.4% on EPS, and then 3.9% on revenue. So yeah, different picture for Apple. And iPhone sales, just to mention those, they're expected to be about 47 billion for the quarter, which would be almost flat on the same quarter a year ago. Yeah, so that's Apple. Just let's have a look at the chart, which you have in front of you. You can see just lagging well below those all-time highs, which were at 260. We're at 218. You've got the black line above here. That's at 222, the 200-day moving average, just below that 38.2 retrace level. Wouldn't actually be that. It would be flip it away. That would be the 61.8 at 223. Apologies about that. And then you've got support around the halfway mark potentially of this decline. That is at 212 or so dollars. And then below that, you get the 38.2 around $200 with the 50-day moving average. That's at $205 on Apple. Finally, Amazon, just briefly, let's touch upon that and grab that chart. Doing pretty well. Again, ascending channel, bull channel, series of higher highs, higher lows. Just quite haven't reached that all-time high at 242.52. So we did spike last Thursday up to 236, but just pulled back now. And then after the close on Friday, 231.44 is where we closed there. Just on those results, then Amazon results. Obviously, again, two sides to the business. Retail will have tariff concerns potentially, as the company, of course, sources a lot from China, and then US probably, I think, is around 60% of revenues derived from the US. Flip side to that, of course, the cloud business doing great. Revenues 17% expected, I think, although competition is coming from Google and Microsoft. Questions around AWS then and redundancies possibly, and whether they can sustain record margins of around 34%, I think they are. Also, I guess it's whether it can scale enough AI compute really, or whether it can scale that fast enough. That will be an interesting question. With, yes, that being sort of in the forefront of investors' minds, as I said, after Google's extra $10 billion. I guess also as well, in case you missed it, we did have, I think, Jeff Bezos. He sold around 5.7 billion worth of dollars of his stock since late June. Whether there will be any questions around that, we shall see. Gone through the technicals, so that is stocks and Amazon, and yeah, those four stocks, which will be reporting Wednesday and Thursday after the US close. Okay, moving on. Let's now look at bear with me. Let's now look at last week's main events, which are, yeah, the ECB meeting, PMI data as well. But just briefly, ECB, well, Stood pat on rates, so the left rate's unchanged at 2%, the depot rate. Accompanying policy statement, nothing to write home about really, all fairly similar. Incoming data broadly in line with the Governing Council's previous assessment of the inflation outlook. Statement repeated the bank's meeting by meeting data dependent approach. That's exactly what we said in our preview last week. And then at the follow-up press conference, President Lagarde was asked about euro appreciation after certain remarks about 120 being a sort of line in the sand for euro dollar. President Lagarde basically, she said that ECB does not target FX levels, is monitoring the situation, but played a pretty flat bat to that. And she also noted that the ECB's baseline scenario from June still holds, despite, of course, at that time on Thursday, of course, Trump threatening the EU, with 30% tariff rates. She did, Lagarde, reiterate the policy remains in a good place. That was probably the big headline, and suggests policymakers not in any rush to adjust policy. And then she underscored the sentiments that the ECB will not be swayed by any temporary undershoot in inflation due to a rising euro. Current 2026 forecast sees inflation at 1.6%, and she added that inflation is still expected to stabilise at target over the medium term. So overall, the message, pretty much the ECB sees itself as well positioned to deal with the short-term turbulence from geopolitics and trade war. And interesting, actually, there was around 15 basis points of loosening seen by year end, 1.5 that is. That was down from 21 basis points pre the ECB meeting. So really the bar has been raised to a rate cut, and especially now in light of this EU-US trade deal. I think now there's only around a 15% chance, 15% chance of a September rate cut by the ECB. So things have moved obviously on that trade deal announcement. And even we got sources actually after the ECB meeting saying that the baseline was for another hold in rates at September. At the September meeting would be a battle for another rate cut, and that has only been accentuated, as I say, with that trade meeting agreement. Sorry, if we just pull up Eurodollar, we do have other data actually. But let me just pull up. I'll pull up Eurodollar shortly, actually. Yeah, so that was the ECB meeting. We also had some PMI data, as I said. Essentially, that showcased. So that's global purchasing managers indices, important leading indicator generally. That showcased basically quicker growth in Australia, slower growth in the UK, little change in the Eurozone. The US basically saw better services but weaker manufacturing, and manufacturing actually entered the contractionary territory below 50, although prices was a key focus and were at highs which haven't been seen for a couple of years. So that'll be interesting going forward, obviously with tariffs potentially as well. Okay, let's get on finally to this week's main events. Lots going on, of course. Oh, just bear with me 1 second, sorry. Bear with me 1 second, sorry, little malfunction here. Sorry, bear with me. There we go. Right, let's move on to this week's main events, of course. First of all, well, we have the Fed. Before I get to non-farm payrolls, we have the Fed first. Well, interesting actually, because this might not be that an exciting meeting, really. Probably a similar statement till last time around. Probably a similar statement to last time around. That means economic activity still remains at a solid pace, unemployment remaining low, inflation somewhat elevated, economic uncertainty as well remaining elevated. So a similar statement to previously is likely attentiveness to risks, of course, on both sides of the dual mandate. Data since the last meeting, well, that supports his wait and see stance as well, or as well as similar statements. So CPI, that's been a touch higher, but and some tariff influences as well. Of course, headline highest since February. Core hit a 4-month high, but then shelter was soft, and that's 40% of the weighting, while core goods actually rose to a 2-year high. So mixed sort of data on the inflation side. GDP, that's well, is expected at 2.5%. Actually, we'll get to that. But then we've had soft data like ISMs actually, and we'll get an update to that on Friday as well. Core CPI, I should say, that has shown increasing. That has been increasing actually with signs of tariffs pass through, as I said. So data is sort of relatively mixed, and it's really then how trade, how fiscal and immigration issues, as well as regulatory changes, how they will impact the Fed's dual mandate going forward. There's obviously this balance between what most economists expect inflation to tick up through the summer with tariffs in the June, July, and August CPI data, but then also potentially see a tick up in the jobless rate as well, the unemployment rate. And then it's how the Fed balances those two issues, which is obviously part of its dual mandate, maximum employment and price stability. Potentially, and we wrote about this in our week ahead, then we might see them waiting for an extended period because the data won't reflect all the tariffs and the deals for quite a few months. So that'll be something to look out for going forward. Yeah, that's generally our sort of thoughts on the Fed, really. Ultimately, the economy is cooling, but it's not collapsing. And we'll see that potentially in the non-farm payroll data. We'll get to that preview shortly. But there is, of course, that, as I said, that lingering uncertainty over inflationary impacts from tariffs. That means, as I said, the Fed won't be comfortable, certainly at this meeting, despite political pressure, cutting rates. Nothing is really priced in. And then markets are pricing in around 16 basis points, I think, maybe a touch less now for the September meeting, with around then 43 basis points priced in by the end of the year. So that's just below 2 25 basis point moves, with obviously this meeting, a September meeting, October meeting, and then December meeting. So nothing this time around, and then 3 meetings potentially with 2 25 basis point cuts. Markets, as I say, 43 basis points or so of easing priced in. So at least one, and then yeah, the chances are, well, will be guided by, of course, this data coming up this week, of course, with non-farm payrolls. Although I should say before the September Fed meeting, we do get 2 more CPI reports and also 2 more non-farm payroll reports as well. So probably cautious, sort of data-dependent stance by the Fed, just to sum up. That is most likely a sort of holding meeting, is what many call it. Possibly a kind of non-event, although of course the press conference will get some headlines. Chair Powell, of course, will be asked about his position regarding obviously the pressure from Donald Trump, but of course he will back that off really, and likely accentuate a patient approach, highlighting of course economic resilience and also that resilience in the labour markets. Yeah, that's the Fed. If we just move on to non-farm payrolls, then we've got a couple of charts on that. Yeah, this might be the biggest market mover on data anyway, and calendar events anyway in the US. We get a bunch of other data as well, but non-farm payrolls likely to show that the economy is still adding jobs, albeit in a relatively modest modest numbers of around 100,000 or so compared to what we have seen. 12-month average is around 151k, I think, and the 3-month average, as I put here, around 150 as well. So the headline around 100 or so thousand. jobs added. Unemployment expected to tick up 1/10 to 4.2% after that surprise dip actually in June, down to 4.1. And then wage growth expected to tick up as well, 1/10 to 0.3% month on month. So that's non-farm payrolls. Again, just a thought or two. It's interesting. I think nearly 90% of all jobs added over the past 2.5 years actually come from just three sectors, as government, leisure and hospitality, and private education and healthcare. And those aren't sectors which are or are key drivers of the US economic cycle. Like if you think manufacturing, construction, technology, jobs aren't coming from those sectors. So just bear that in mind, of course, with this number coming up. Otherwise, yeah, fairly stable. Obviously, slower labour market growth going forward is expected, although with declining immigration, potentially that unemployment rate may stay fairly steady. Yeah, that's non-farm, and here you've just got a chart with you showing really the print for the headline number could be the lowest since February, I think, so a 5-month low. Other data, just for your guide, we get that core PCE deflator data, the Fed's favored inflation gauge on Thursday. That's likely to come in a little bit hotter at 0.3% month on month than the 0.2 recorded by CPI. That's due primarily to the weightings of key components feeding into the PCE data. Do we hear, I know there is speculation about rate cuts possibly in September and whether Fed Chair Powell does open a door for cuts in September. Will be interesting, and whether he wants to just see more data, as I said, tariff or data being impacted by tariffs, then potentially that might be a tough one to see. We get Q2 GDP data as well out on Wednesday. That is could come in hotter actually than the market is expecting. Consensus sees around 2.5%. I think that's due to a strong combination from net trade, given the collapse in imports, and decent investment performance. It basically actually that 2.5% reverses the Q1 surge in imports as firms obviously front-loaded tariffs basically ahead of that April the 2nd Liberation Day announcement. Probably then better to take an average of Q1, Q2 GDP numbers, but also then watch the consumer spending numbers. That's, of course, been a key growth engine for the US economy since the pandemic, but they have stalled since sort of late last year with that sort of caution around tariffs, jobs, and then quite sharp swings, of course, in equity-related wealth, which has ultimately deterred sort of households from spending too aggressively. So a lot of data out of the US as well. Sorry, I should say employment cost index. And also then the build up to non-farm means we get JOLTS report out tomorrow, actually. That's jobs vacancy report. So just watch quits rate there because that can signpost earnings growth as well. And then we get ISM data out on Friday. Okay, just quickly then as well, let's just go to then the Bank of Japan meeting. Just briefly, there's a chart here showing you how elevated CPI is at the moment, contrasting with the benchmark rate just above 0%, 0.5%. BOJ, concludes its 2-day meeting on Thursday. Has, of course, seen its plans to normalise monetary policy delayed by, both economic and market volatility from Trump's tariff policies and then domestic issues as well, potentially, of course, especially recently with that Ishiba upper house election result. Trade pack, or that recent Japan-US trade deal, of course, does now reduce economic uncertainty. That then increases the likelihood that Japan will hit its inflation target, and that's what Deputy Governor Uchida said. Meanwhile, speculation growing that, of course, then domestically, possibly PM Ishiba, who has been a fiscal hawk, he will step down after that disastrous electoral showing. Then, though, that paves the way for basically more spendthrift policies and potentially then a sales tax cut, which would address possibly the cost of living crisis, but then as well push back on rate hikes. For the meeting, just watch out for the quarterly macro outlook updates. We may possibly get upward revisions to inflation. Economists, they expect a rate hike of at least 25 basis points by year end. And I think markets pricing in around now a 50% chance of a move in October. Obviously, the trade deal out of the way is critical for the Bank of Japan. They've noted that before. And then it's just whether they give a signal about a possible rate hike in the coming months after the summer, likely. Interesting for the yen, that has experienced the biggest volatility adjusted moves around Bank of Japan meetings over the past year. So, of course, a hawkish signal, like an upgrade to growth or inflation, or then a reduced caution on future rate hikes, could see a pretty decent reaction. If we get pull up the dollar yen chart, which is here. Yeah, we can just see we've got resistance around the black line, the 200-day moving average is at 149.53. That's the halfway point of this move lower this year. That's at 145.37. So that's probably a decent zone of resistance. We're just sitting on the 38.2 now. No, just above that actually. Sorry, at 147.13. And then below that, you've got the 50-day moving average at 145.28, and then a minor fib level at 144.36. Okay, that's Bank of Japan meeting. Just quickly, sorry I'm going on here, but there's so much going on. Let me put up a dollar CAD chart here. We have the Bank of Canada meeting on Wednesday as well. They're expected to keep rates at 2.75%. Probably remain cautious amid still trade uncertainty for Canada and well, that US trade deal, but also unexpectedly positive data. So we've seen the jobless rate move down to 6.9%. We've seen month-on-month CPI at 0.1%, and we've also seen business and consumer surveys improving somewhat. So yeah, interesting mix for the Bank of Canada to contemplate. Risk possibly are for some economic weakness going forward, so more than the one rate cut priced in, I think it is at the moment. Possibly then, do we get dovish leaning because of no trade deal on the table really at the moment? Focus will be on then the statement and tone as well as the press conference going forward. Recent communications from the Bank of Canada guys, officials, have been neutral, slightly dovish. So I think there's only around 6 basis points priced into September. Is that too low? Possibly. But for dollar CAD, you can see possibly forming a base around 136. Potentially, we have broken that downward trend line. Certainly, if we can get above that mid-July high at 137.74 and above then the blue line, the 50-day moving average at 136.94, if we can get above those decisively towards 138, then potentially this is a base. Otherwise, yeah, strong support just below 136. Which possibly caps the downside. That's dollar CAD. Then also we have Eurozone data, as I said. We get GDP data and also inflation data. GDP data probably might give us a reality check out actually after the Q1 strong data on the back of that was US tariff front loading. April data probably showed a dip in production and exports, although that was followed by a surge in especially pharma production in May. Overall, yeah, it's the impact of US developments on this sort of backward-looking data actually probably will be the issue. Service sector has had a few weak months, judging from the survey data, and that may also add to the weakness. Inflation data then out of the Eurozone on Friday. Of course, as I mentioned, Lagarde emphasized numerous times about being in a good place, inflation under control, but also the undershoot. She wasn't worried about. Just for your guide, expectations for Eurozone inflation are seeing in the headline a pullback from 2% to 1.9%, and the core moving to 2.2% from 2.3%. There could be more upside from services again, but the firmer euro probably could offset downward impetus to goods price inflation. Euro dollar, then you can just see this sell off after today's deal announcement or the weekend's deal announcement. You've got 118.30 is that high. And then we have sort of a cycle high there, a 116.31, another one at 115.72, and then you've got the 50-day moving average, which has acted as decent support. That's around 115.63. Okay, just briefly, finally, let's wrap up with the Aussie news coming. Sorry, that's about the Australian inflation data. That's out on Wednesday, potentially tease up the August RBA decision and potentially validates that 25 basis point rate cut at the August 12th meeting it is. At the last meeting, the bank signalled it would wait for more inflation data before easing further, aiming really to ensure progress towards its sort of 2.5% target, which is obviously between that 2 to 3% target range. Core inflation will be key, so that's trimmed mean and weighted median, and they have remained within that target range, 2 to 3% for the past 2 quarters. So yeah, focus on that, and then also beyond inflation, we do get to see Q2 retail sales as well on Wednesday, I think. So give us an assessment of the Australian consumer. Monthly retail sales growth through May has been modest, but broader household spending for May actually showed a strong rebound. So sort of mixed signals on consumer strength. So just watch out for that data as well. You can just see we did have in Aussie dollar, this chart, of course, a break higher above 66, but that didn't last long. And now we're back again to, well, the 50-day moving average, actually, which is at 65.09. So whether that caps the downside, otherwise you've got that swing low from earlier this month at 64.54, with then resistance, as I said, around the 66 mark. Okay, we'll wrap it up there. Yeah, the August 1st tariff deadline, of course, I should just mention, is, well, probably going to be pushed back again. I think we've had different views from some of the officials in the administration. Lutnick said that was a hard deadline, but then Treasury Secretary Besant has hinted at possible extensions. Obviously, deals in the pipeline all this week, and Besant really has said that it's not really about the timing; it's about the quality of the deal, and that's really what markets are going ahead, looking at, and really not focusing on that being a cliff edge, if you like. Okay, please do follow us on social media. Really do appreciate you sticking around for 53 minutes. Really do hope that's been of use to you guys as well. Don't see any questions at the moment, so yeah, hope that's been of use. As I said, we are also we do have another webinar on focused heavily on earnings. And especially the Mag 7 earnings that we have seen and we're about to see. That will be tomorrow, as I say, 11 a.m. UK time, 8 p.m. Australian time. I think that's 6 p.m. Malaysian time. So, yeah, please do tune into that. Yeah, follow us on social media. Do take care out there, as so much is going on. But exciting, a very exciting week ahead, and we will speak to you very soon.